Okay, so welcome to your first lecture on our first class on how to measure corporate performance. This is the module 2 we are talking, and this is the most challenging part of module 2. So I said, okay, let me come straight to the point here. And this also relates to, as I said, it relates to your case study also in module 4. So, and in general, it relate to lots of other things. So this very, very useful. So let's go ahead with this. What we will learn here is how to use financial ratios to understand the value and value added concepts. We'll talk about measuring market value and the market value added. And we'll talk about accounting rates of return. As you must have seen in chapter 1, what is the main purpose when you are running a company? The main thing is, as you must have seen from chapter 1, is to be able to contribute to the wealth of your shareholders. So that is, if you can keep your shareholders happy and increase the value, the wealth of your shareholders, you have done your job. So that is the moral of the first chapter at the end. The goal of financial management is to enhance the wealth of your shareholders. Of course, doing everything else, what you're supposed to do. But in the end, the bottom line is the people who own the company, their value should increase. So the question is, how can the value be increased? So when you see that, there are two things in improving the company's performance: the returns and the risk. Maximize the return, minimize the risk. And that way you can add value. So when we want to know whether some value has been generated or not, you have book value, you have done your accounting basics, you will see that in accounting you have book value. In the accounting statements, you have book value. And book value is what? The cost principle says everything is at cost. Every transaction is measured at its cost. So it is not the market value. But you want to know whether your company, this company that you're measuring, it has performed in such a way, it has operated in such a way so that its value has increased, overall value has increased. So that can only, how can you increase the value? Through the operations, right? And to operate your company, you need assets. And for those assets, you need to buy those assets. Those assets don't fall from the sky. So you invest in those assets. And to invest in those assets, you need to finance those assets. You need to raise money for those assets. So there are only two ways you can raise money, either through debt or through equity. So coming back to your accounting basics, your business is what? Let me explain it to you this way. New share, I'll do through a whiteboard. Share. So what is your business? Your business, if this is your business, sorry, I'm making it like this here. And one side of it is assets. And the other side of it is how you raise these assets, how you finance these assets. So these are your liabilities, two ways only. You have your liabilities and your equity. So on the left side, so this is your company, this is your assets on the left, and on the right, And on the right, here, you have your liabilities, how you raise these assets. Financing. So all your financing decisions are on the right here. And your assets should equal, pardon my writing here, your liabilities plus your owner's equity. Owner's equity. So this is your whole business. Investing decisions, investment decision is here in your assets. And financing decision is here in your liabilities and equity. You understand? You use these assets to run your business. So we are back here. So investing decision and financing decisions. These are the two things you do. So first we will learn how to measure the market value added, whether the company has added value or not. Then we'll go into specifics for the investments, through the investments, whether you have done well or not. So here we will look at through whether your profits are there or not, and all the profits, how to make those profits, the EVA, ROC, ROA, ROE, return on equity, these are all measures of profitability. And how do you generate profits? Through operations, profit from sales, operating profit, or through efficient use of your assets. Both are related actually. So all your turnovers are important over here, whether you are using your assets properly or not. If you are using your assets efficiently, they will generate profits and your profits will be high. Now, through the financing decision, are the financing decisions right or not? How do we measure that? Well, the important thing is whether your leverage, your debt ratios, interest coverage ratios are right or not, whether your whether your borrowing is okay or not, whether you have borrowed wisely or not. So this is your financing. All your leverage ratios will be here. And then financing, very important here, is liquidity, whether you have enough liquidity or not. Liquidity means how easily you can convert your assets into cash. So whether they are liquid enough or not. That is very important. So current assets, quick assets, your cash ratios, these are important over here. So just to give you an overall idea of how to measure your performance. All right. So there we go. The concept of market value added. The concept of market value added, market to book ratios. When we are talking of the market value, first thing we have to understand is what is market capitalization or the market value of your equity. You start your business with, your investments. So let's say you're 100% sole proprietor, like chapter 1, sole proprietors, partners, LLCs, corporations. So let's say you're 100% shares you own, you're the sole proprietor. And you have invested a few dollars. That is your equity in that business. That is your equity in that business. And when you are investing in your business, at that time, it is your initial investment that you are making. But what is the market value of that investment? It's very easy to measure that when your company is public. So corporation is easy, but what is the real market value? So if you're taking, say, Microsoft shares, if you own Microsoft shares, you can easily know the market cap of Microsoft by taking the number of shares outstanding and multiplying them with the share price. So the total market value of your equity is equal to the share price times number of shares outstanding. So when we want to know the market value of a company, we take the number of shares and multiply it by the price of each share. Now, this is very easy to measure for public companies. For example, ABC firm has 100K shares outstanding at $90 per share. The market value is what? 100K times $90. That's $9 million is the market value of this company. Market value of equity, that is the market capitalization it's called. So that is the market value concept. Now, obviously, the larger the company, the larger will be the market value over here. That is, small companies won't have large market caps because the number of shares will be less there. Now, I'm not talking about private companies here, just public companies, public corporation. For private corporations, it's a different way of measuring the value of the business. You take the net income and the cash flows, and depends on the cash flows generated by that private business, and the market value depends upon that. So, but the question is, what is the market value added? How much market value have you added to your business through your operations? You can get that by subtracting the book value of equity from the market value of equity. So you get your market value added is the market cap, which you calculated earlier, minus the book value of your equity. So that is same example of ABC company that we are using, where the market capitalization or the market value of shares is $9 million. And if the book value of the equity is $3 million, then the MVA or the market value added is how much? 9 minus 3, that is $6 million you have added to the book value. That is called market value added. So that's how you measure whether you have added value to your company or not. Okay? By taking the market cap and subtracting the book value of your equity from there. But as I said, for larger companies, it is very easy. Larger companies will have larger market value because there are more shares there. It's a huge company. But for small companies, you can't compare MBA of one. Okay, MBA of this company is big and this company is small. Or this company is small by nature. It is not a large company. So the market cap will not be large for this company. So you compare an apple and an apple. So what we do is we go on a per dollar basis and we go to market to book ratio. The market to book ratio tells you how much the market values each dollar of the equity on the books. So on your balance sheet, if you have $100 of equity, how much is the market value of each $1 of equity? How much does the market value each dollar of your equity? That is the market to book ratio. And that is a nice ratio. In fact, this ratio became very hot in the 90s and it's become very popular on Wall Street, actually. Market value of equity divided by book value of equity. When you value companies, and you will see later that we use risk of the company is very important there also. So the capital asset pricing model typically uses the beta of the company to value shares. So beta is a risk, the systematic risk of the company. And this had been going on for ages. When beta came into existence in the 60s, after that, all these people, the Chicago Business School people, they got Nobel Prizes for that model, what they did. And it is followed religiously by Wall Street in valuing companies. But then in the 90s, you had Eugene Fama and Kenneth French, they came up. They said that no more beta. No, beta doesn't seem to work as efficiently as the market to book ratio. And that is where in 1992, 1993, it became very, very popular, this market to book ratio, And after that, the valuation company use this also. This is very popular. So how do we get this again? There is an example I've given here, ABC, 100,000 shares, same company, outstanding, 9 million market value of equity and 3 million book value. So the market to book ratio will be market value of equity of 9 million divided by the book value of equity, which is 3 million, that is 3 times. So that means the market values each dollar of equity of ABC company as being worth $3 now. So 3 times. This is a very, very important number. It tells you how popular you are, how valuable your company, how the market values your company really. And you will see that some of the companies, these are, as you will see, hundreds of times, so many times it market values, and not just 1, 2, or 3. Look at Amazon, look at the others, you'll see. So I've said over here, note that ABC, the market value per share or share price, equals the market cap or the market value divided by the number of shares outstanding. I've explained it to you. So I've written it here for you. So, as I said, a shareholder's value depends upon good investment and financing decisions. Both are important. And to evaluate good investment decisions, when we are talking of decisions, so investment decisions. So to evaluate good investment decisions, we ask questions like profitability. How profitable are the investments? How profitable are the investments relative to the cost of capital? Look, typically all your accounting ratios will tell you that, okay, your profits are what? Your revenue minus all your expenses, net of taxes, that gives you your net income. That's your profit. That's your accounting income. That's the accounting profit. It tells you what happens after you deduct all your operating fixed, variable, all your operating expenses from your operating and non-operating expenses. You have operating expenses, you have undistributed expenses. Again, we keep referring back to accounting. Finance begins where accounting stops, really. From there, we just pick up numbers from there. So in your income statement, you have your revenue, then you deduct your operating costs, then you deduct your undistributed costs, then you deduct your fixed costs, and then you get your income before profits, before taxes, and then you deduct your taxes, and then what do you get? Net income after taxes. That is what they call as profit. But actually, what they are forgetting is the cost of your capital, the cost of your financing, that they are forgetting. That how much does it cost you to raise each dollar of your capital? That is what you must also include. As long as your returns beat your cost of capital, you are in the money. So we come to important ratios now, economic value added, EVA, those kinds of things. So how profitability is measured? I said EVA, return on capital, return on asset, return on equity. These are some of the ways, right? And what does profitability depend upon? two things. One is your profit margin. How efficiently, whether you are able to control your costs, generate enough revenues, right? So operating profit margin, that is important. Revenue minus your operating costs. But the other thing that is equally important is how efficiently you are using your assets, your inventory, So all your turnovers of assets, inventory, receivables, all these are very important. So all the assets, remember, you're using your assets to run your business. How efficiently you're using those. That is another important aspect. And both together, they add to your profitability. And we will see that as we go along. So we measure profitability through 4 important ratios over here. And these are by far the most important family of ratios in ratio analysis. And all your other ratios will be related to these ratios, other families of ratios. So EVA, ROC, ROA, and ROE. These are the first things you look at. And in your book, they talk about Home Depot as an example, and consistently they keep using that throughout. So when we talk of ROC, return on capital, what is the capitalization? First of all, long-term capital is what we are talking of when we talk about ROC, capital. So long-term capital is your long-term debt plus your equity. So this is what your long-term capital is. So net income plus your after-tax interest as a percentage of long-term capital. This is your ROC. And the whole thing is not to memorize these ratios. The important thing is to be able to understand the meaning and use of these ratios. Because these ratios are available there all over the place. They are available. So you can get those formulas. But to be able to interpret it, this is the important thing. And how to use them, when to use them. So return on capital, again, how much net income plus your after-tax interest as a percentage of long-term asset. Why do we add the after-tax interest? As it is explained, when you'll read your book, it is explained there very well, actually, and there are footnotes also explaining those. So interest payments in businesses, when we can use that for tax deductions. So there is a tax advantage of that. And what do you pay interest on? On your finances, your financing, whatever you borrowed, isn't it? So when you want to know whether your business is generating income or not through its operations, you do not want to include the effects of financing in that decision. Financing is a separate decision. So that is why we take the tax shield and the net income plus the after tax. The tax shield is removed. The tax shield is income. It is benefit, right? So we take 1 minus tax rate times the interest. That is the after tax interest. We add that to the net income. So that is from pure operation. That is your operating profit margin. Net income plus after tax interest is your operating profit margin. You deduct that, you divide that by your long-term capital, then you get your return on capital, your long-term capital. Okay. Then you want to know the return on your assets. Again, they use the same thing over here, net income plus after-tax interest. They want to know pure operations, your operating income, pure from your operations, as if your company was 100% equity financed, no debt involved here. Then you can compare all the companies equally, right? Easily, apple with apple. Otherwise, you take net income someplace and one company is financed 60% by debt. Another company, you take the net income, it is financed 20% by debt, then you're comparing an apple and an orange. So you want to compare the net income of the income from operations of companies as if they were 100% equity finance. That is why you add the after-tax interest to the net income. You take into account the interest, the debt tax shield that is called. So here also for your assets, we'll take, your net income plus the after-tax interest as a percentage of total assets. That is what we call the return on assets. For equity, what they do is just take the net income because it's 100% equity anyway. So net income as a percentage of shareholder equity. This is 100% equity. So take net income divided by the percentage of share as a percentage of shareholders' equity. So ROE, you take it like that. Once again, memorizing the formula is not the point here. The important thing is to understand the meaning of it. And you will find that in different textbooks, these formulas are used differently. People don't even use they simply use the net income for all. ROA, ROC, ROE, they will just use the net income without adding the after-tax interest. That is not accurate, actually. That is not the right thing to do, because different companies have different leverages. And you don't want to include that in your decision just now, about the net income, your profitability of that company. So that's why we use that, the net income plus the after-tax interest. So when we talk of ROA, as I said over here, your return on asset will equal return of equity if a firm is all equity financed. If it is all equity financed, there is no interest. It is zero because there is no debt. So net income is net income, period. So your ROA is equal to ROE if a firm is all equity financed. Remember that. It's the same thing. Right? So these are some profitability measures. But the important thing over here is the economic value added. Okay? The economic value added. And we will talk about this, I'll just pause the recording over here. So we talked of 4 important ways to measure our business profitability: economic value added, return on capital, return on asset, and return on equity. We talked about return on capital, ROC, return on assets, ROA, and return on equity, ROE. Let's now talk about economic value added, a very important concept. We'll talk about economic value added, then we'll talk about measuring efficiency, then we'll talk about how to use the DuPont system to analyze the return on our assets. These 3 things we'll talk just now before our next break. So economic value added is also called the residual income. It is called the residual income. Why do we call it the residual income? It is the after-tax operating income. The after-tax operating income. Remember what we use for return on capital? The after-tax operating income minus the cost of capital times the total capitalization. So what it does is, it takes your after-tax operating income from your operations, only from your operations, remember. So how do you get that? You get the net income plus 1 minus tax rate times the interest rate. That is your after-tax operating income. And you deduct the cost of capital times the total capitalization. So here it is economic value added we call residual income because it is residual of what? After deducting the cost of capital. Take the after tax operating income and deduct the cost of capital. The cost of raising each dollar of your capital, that part, that has to be deducted. And then whatever income you get, that is, Stearns and Foster, these companies, they came up with this concept. It is a recent concept, EVA. And they came up with this because they said that, look, what about the cost of raising your capital? You have not included that in your accounting net income. So deduct that also, and then you will get the real economic value added, if you have any economic value added. And that can only happen if your cost of capital is less than your after-tax operating income. Okay? You'll have a positive EVA. So your after-tax operating income, as I said, it is your net income plus the 1 minus tax rate times the interest expense. 1 minus tax rate times the interest expense. This is your tax shield plus the net income. This is your after-tax operating income, pure from operations, from an all-equity company, regardless of your financing decision. And from that, you deduct the cost of your capital. So your cost of capital times the total capitalization, that is the total capital that you have raised, right? That is times the cost of your capital. How do you get the cost of your capital? First of all, total capitalization is what? Your long-term, debt plus your shareholders' equity, as I said. This is the long-term capital, total capitalization, or total cap, we call it, is a long-term capital. So how much did it cost you to raise that? That is the total cost of your capital. Cost of capital times the total cap, which is your total cost of the capital that your long-term capital that you have raised. How do you get the cost of capital? We will learn this, again, in chapter 13 or so. We'll learn this later. But once again, you take the weight of your debt times the interest rate, 1 minus tax rate times the interest rate. That is your weighted cost of debt. So once again, I'll for you to understand, I'll not you're not supposed to learn how to calculate it now. We'll learn later on. But just to explain to you the concept of how do we get the cost of capital. For every business, it is unique, and for every industry, it is unique. The cost of capital. It depends upon the risk of that company also, and risk of that industry. So that cost of capital, what is that? Once again, let me go here to the new share and go to my whiteboard and come back to the same thing over here. This was your asset. This is the asset part, and when you raise this asset, you raise it by raising the finances through debt, which is the liability, or from the owner's equity, right? So what you take is the weight of debt, how much, so maybe 50% debt or 40% debt. Here in this case, I'll say 60% debt, 60% debt. And this is, say, I say here 40% equity, right? So if it is 60% debt and 40% equity, the weight of debt is 0.6. The weight of debt will be 0.6. So this will be WD. So I'm just writing it in abbreviation. This is WD, and this is weight of the equity. So I take the weight of debt times 1 minus tax rate times the interest rate. Interest rate is the cost of debt, right? So this is the weighted cost of debt plus the weight of equity times the cost of equity. KE, I'll write cost of equity. So this is your weighted average cost of capital. WACC it is called, weighted average cost of capital. And this is unique for every firm. It is unique for every industry. So that is what we take here for weighted average cost of capital. And we'll learn more of this as we go around. It depends. Again, your cost of equity, how do you get the cost of equity? You know, this is a function of capital asset pricing model. Your cost of equity is a function of capital asset pricing model. Why it is not coming here? But this is a function of capital asset pricing model. And the cost of equity, I'll write it. No, this is not coming. Anyway, we'll explain it later, the cost of equity. So I'll go to new share again, and I'll go back to our EVA and to share. I'm back to my slide here. So that is the cost of capital. I mean, you can go on and on. This is a separate topic in itself. So, but for now, this is enough. You'll understand the cost of capital. For Microsoft, it will be much higher, the cost of capital. But for a utility company, the cost of capital will be much lesser. Again, risk is involved over there. How risky is IT is more risky than utility. Although what is happening is in Texas right now is strange too. One will think, oh, it's not supposed to be risky, but the power grid is failing. So there is risk everywhere. So that is the economic value added. This is the concept of economic value added. Residual, after take the after-tax operating income and deduct the cost of capital from it. And if you get that as positive, then yes, you have added economic value to your company. It's very simple. Marginal return should be greater than marginal cost. If your return is not equal, if it's less than the cost of raising that money, then how will you make money? So remember here, the main cost that accounts for the difference between accounting income and the EVA, which is economic value added, is the firm's cost of capital. Firm's cost of capital is the important thing. So EVA is the after-tax operating income minus the firm's cost of capital, as I explained earlier. It is a better measure of a company's performance than simply the company's accounting income. And there are companies just computing these things. In contrast, accounting income is calculated after deducting all costs except the cost of capital. Very important to understand this. So if a firm, and as I said earlier, if a firm's return on capital, ROC, is less than its cost of capital, marginal return is less than marginal cost, basic economic principle, then the firm's EVA will always be negative, regardless of a positive operating income or ROC. Even if you have positive return on capital, you will still have a negative economic value added if your cost of capital exceeds your return on your capital. But remember that. And that's why, when you see in your the list of these companies here, you will see, all the figures in red, over here. US Steel, Xerox, Time Warner, Bank of America, classic example. These are all negative EVA. And these are all where you see the return on capital is less than the cost of capital. So in Bank of America, the cost of capital is 5.9%, whereas the return on capital is 1.3% only. So obviously the EVA will be negative. And as long as the return on capital beats the cost of capital, which is starting from FedEx, you are seeing 6.1%, it beats 4.9%. From here onwards, this will all be positive EVA. Got it? So this is very important to understand. basic, principle of value-based planning. Marginal return should beat the marginal cost. So the cost of capital is very important. So what does profitability depend upon? As I said, efficient use of your assets, your turnover of your assets, turnover of your inventory, turnover of your receivables. Once again, your basic accounting comes handy again. Inventory, receivables are current assets, whereas your total assets, your long-term assets, are long-term assets. So these are short-term assets, and the long-term assets, you have total, it becomes total assets. So when you're talking of turnover of assets, you're talking of total asset turnover. Then you have your inventory turnover. Then you have your receivable turnover. These are all your efficiency ratios. And then, of course, your operations, operating profit margin is also equally important over here. And efficiency ratios, as I said, they measure how well you use your company's assets. Or over here, when we say asset turnover ratios, so when we talk of efficiency ratios, you have your asset turnover ratios. You take the sales divided by your total assets at the beginning of the year. This is another point to understand. Sales divided by your total asset at the beginning of the year, or sales divided by average total assets. Once again, let me explain this to you. Why do some ratios use, average total assets, average balance sheet figures? Look over here. The sales is an income statement figure. The asset is a balance sheet figure. So some analysts will say, look, we have to take the average of last year's assets and this year's assets and average them into, divided by 2, and that becomes my average total asset. That is my base. That is my benchmark for comparison. Others say there is no point for doing that. We just take the assets we started with. We started the year with this asset. That means last year end, that is the beginning of this year. And I take that as the benchmark. But okay, I use these assets and my sales generated, each dollar of that asset produced so many dollars of sales. So whichever way you do it, be consistent in your analysis. That would be my humble advice. So interpret it as the dollar sales generated by every dollar of your assets. Higher this turnover means you're using your assets, efficiently, and each dollar of your asset is generating more and more sales, more and more revenue. So here is an example for you to look at. ABC, I always look at ABC company. So ABC sales for the period is $74,754. So for my sale is $74,754, and my total assets at the start of the year is $40,742. So how much was my sales, my asset turnover? My asset turnover simply means how many dollars of sales were generated by each dollar of my assets, ABC's assets. ABC generated 74.754K sales from 40.742K asset. So each dollar of the asset generated sales divided by total asset at the start of the year. So I'm taking 74.754K divided by 40.742K is 1.83. Means each dollar of ABC's asset generated $1.83, $1.83 of sale during this analysis period. Once again, higher the sales, better it is. Got it? How many times these assets are turning over? Again, industry is very important here. If you have industries with, huge assets, long-term huge assets, then for them, the sales per dollar of asset will be less. On the other hand, if you have asset-light companies, asset-light strategy, this is very important these days. people don't like to own real estate, they will lease it, right? Franchising, what is that? Asset light strategy. You don't block your money in real estate, but you sell your franchise name and you generate revenue from that. So you're asset light. So for asset light companies, the asset turnover ratio will be much higher. So in general, you will see. Then you can go more specific. You can talk about inventory turnover. Now, how efficiently are you using your inventory? Whatever inventory you have. So when you're talking of inventory turnover, then you take, instead of sales as the numerator, it is, they say that, look, my inventory is valued at its cost, the cost principle, right? The revenue is valued by sales, but my inventory over here, when I'm talking inventory, my inventory is valued at cost. So it is always good to compare my cost with cost. I say, what is my cost of sales? So that means how much inventory I sold, cost of the goods that I sold during the year. Cost of sales is the most direct cost, first cost in accounting when you deduct the first operating cost. So if you're selling, for example, if you're selling nuts and bolts, then what is the cost of, the raw material for that? Or if you're selling a hamburger, then what is the cost of the, raw material, food raw material? That is the cost of goods sold, right? So the cost of goods sold divided by inventory at the start of the year, how much you started with. So if ABC's cost of goods sold is 48.912K, and the inventory to begin with, ABC started with 10.36K inventory, $10,360 worth of inventory, then your inventory turnover ratio is what? Your cost of goods sold, 48.912K divided by 10.360K, which is 4.70 times. We say that means my inventory has turned over 4.70 times during this analysis period. Got it? And if you take this inventory turnover and divide it, if you take the inventory turnover, yeah. So 4.70 is the inventory turnover. And if you want to know on an average, how many days are you carrying this inventory? Are you carrying this inventory in your business? Then all you have to do is you take the inventory at the start of the year divided by the cost of goods sold by per day, cost of goods sold per day. So that is divided by cost of goods sold divided by 365. So essentially, if you do that, then you're talking about $10,360 of inventory to begin with, divided by per day, per day cost of goods sold, which is 48,912 divided by 365 days. That is 77 days total is how long you're carrying this inventory in your business. ABC carries its inventory on an average for 77 days. Again, it depends upon the type of business you're in. How long should your inventory stay? If your inventory is perishable, it moves fast. If it is not perishable, it moves slow. If you are dealing with precious metals and jewelry, inventory will stay much longer with you. So again, it depends what business you are in. Every industry has its own trend. All right. And how do you get these trends? If you want to know, so okay, let's talk about trends later. Let's move on further. Then after inventory turnover, what do we look at? Okay, Receivables is another important. Accounts receivable. Remember, in your current assets section, you have cash, then you have marketable securities, then you have accounts receivable, right? Then you have inventory. These are in the order of liquidity. They are less and less and less liquid. So cash is the most liquid, and then you go less liquid. So accounts receivables is a very important part of your current asset because most of the businesses use credit card sales and credit sales. So accounts receivables is very important. You know, accounts receivable what? It is credit sale for which we have not received cash yet. And to be efficient, you need to, collect your cash fast so that you all see. Remember, the income and all those things that you see, revenue, all those things that you see, these are all accrual accounting figures, not cash accounting figures. Again, we come back to the basics of accounting. What is accrual accounting? All the numbers that you see in the income statement, balance sheet, these are all accrual numbers. Regardless of whether cash has exchanged hands or not, if a sale happens, that cost is incurred. That is recorded. That is accrual system of accounting. So if a sale has happened, it will record it as a sale. Whether you got cash for it or not, it doesn't matter. That is accrual accounting. So the net income figure in the income statement that you see doesn't mean you got so much cash in your hand. For that, you need to manage your cash. That's why you need a cash system of accounting for that. Separate your statement of cash flows. And you also look at your cash account, you look at your accounts receivable turnover. If you've seen accounting, when you did your accounting, you will see that you don't have to look at anything else. You want to see how your cash changed from last year to this year, you can simply close that cash part and look at all the other parts of the balance sheet, and you can tell this is how the cash moved. This is the statement of cash flows. Cash from operations, you look at the current assets and current liabilities other than cash. Current assets and current liabilities, changes in those. Cash from investing decisions, your long-term assets and your investments. You look at that part of the balance sheet. And cash from financing decisions, you will look at your debt part, the liabilities, and the owner's equity part. And bingo, you can easily say that this is how cash has moved. But cash system of accounting, those numbers that you see in the balance sheet and income statement, they are not cash. So for that, you have to track your cash, and that's why you have to collect your cash fast. Your sales, you have to collect, make sure your credit sales, you got to collect fast. That's why you track your receivables, accounts receivables. So therefore, turnover, account receivable turnover. Sales, just like your asset turnover. So you take sales divided by receivables at the start of the year. So, for example, if this company, the sales are $74,754 as before, as I said, and the receivables at the start of the year were $1,252, then your receivables turnover is 60 times. That means 74,754, which is your sales divided by your receivables at the start of the year. That is 60 times your accounts receivable turnover. And if you want to know how many days on an average you're carrying this account, then you take the average daily sales, receivables at the start of the year, divided by the average daily sales. And that will give you your average collection period. How many days does it take you to collect that accounts receivable? In this case, 1252 is the receivables at the start of the year, and 74,754 divided by 365. This is your daily, average daily sales. So that is 6.1 days it takes you to collect the average collection period. Got it? So this is how you look at the efficiency ratios, the different turnovers. The faster you collect your receivables, the better it is, right? But if you're collecting your receivables too fast, it could also signal that you're not giving enough credit to your customers. So you got to be very careful. Make sure that you stick with the industry averages, and you are consistent with the other, with your comp set, your competitive set. Otherwise, you'll find that you are collecting, you're not giving enough credit to your customers, so your customers are running to your comp set, your competition across the road, and you will lose your business in the long run. So both are important. You have to collect the money in a timely manner, that is important, so you can pay your bills on time. Because you cannot pay your utility bills and other bills with IOUs, with your net income. You can't say that, okay, here is my net income. Net income is accrual accounting, it's not cash. Your vendors, your suppliers need cash. Cash means not just currency cash, your bank account, everything in accounting, it's all included in cash, definition of cash. So you have to write checks to them, you have to transfer cash to them. You can't pay them with IOUs. That's why you need to track your receivables, make sure, you track your cash. So these are efficiency ratios. These are very, 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 very important. Okay. And they tell you how efficiently you are using your assets. You can do that for any asset. It's entirely up to you. Accounting is not limited, or managing these ratios is not limited to certain ratios like this. You can create your ratios. You can create your analysis. In fact, how efficiently you analyze your business or any business is a function of two things. One is your experience and your creativity. How experienced you are in this. That is, your insight is very important. And the other is a little bit of knowledge of these ratios. So you can link these ratios, you can create new ratios out of them. Nobody knew about market to book value ratios. Nobody knew. They were talking about beta, risk. But somebody came up with this, and very famous people, they came up with this and they said, look, this is what it is. They were creative and they found this. So again, analysis, creativity is very important in analysis. Keep that in mind. Okay. Finally, how to connect these ratios. Of course, other than this, you have operating ratios also. Operating ratios means in every business, I said, the cost percentages, the labor cost percentage, the utility cost percentage, the marketing cost percentage. These are all, in every field, it is different. Your operating costs percentages, cost of sale percentage, it's all different for different industries. So those are equally important. Some industries are labor intensive, some industries are not labor intensive. Again, you have to see those things. But creative analysis involves linking ratios together. And the DuPont system of analysis is a system that helps you link these ratios together. And again, there is no hard and fast definition of DuPont system. You can create DuPont trees by interrelating ratios one with another and creating a DuPont tree. Okay. So here we'll show you how ROE and ROA, return on equity and return on asset, can be broken down into component ratios using the same example of ABC that we are talking about. Now, the profit margin for ABC company, net income divided by sales, if we take, net income is $4,535 given, and the sales is $74,754 given. So my profit margin for ABC is 6.1%, 0.061 or 6.1%. This is the profit margin. Net income as a percentage of sales. How much net income after taxes this company generated for each dollar of sales that it made? How many cents of net income after tax? So 6 cents, 6.1 cents, of net income after tax it generated. Okay, fine. But how much of it came from operations? Because remember, this profit margin is a function of operating decision as well as financing decision. How much of it came from just from pure operations? For that, you have to take your after-tax operating income and not the net income as a percentage of sales. And after-tax operating income is the net income plus 1 minus tax rate times the interest expense, as we did earlier. So in this case, my net income is 4,535. My tax rate, typically corporate tax rate, they take 35%, around 35%, and it's a whole number. You don't have fractions as tax percentages. So we take 35% as the corporate tax rate. So 4,535 plus 1 minus 0.35, 1 minus tax rate times 632, which is your interest cost, interest expense. This is your total, is your after-tax operating expense. Net income plus your debt tax shield, interest tax shield, as a percentage of your total sales. So if you take the operating profit margin, that comes to a little bit more, that is 0.066 or 6.6% from pure operations. The 0.5% came from financing decision. Okay, so this is from pure operations. That is 6.6%. This is your operating profit margin. Now, these are very handy when you talk about ROA and ROE, and we'll tell you how over here. When we talk of ROA, return on asset, you can easily say, what is the return on asset? Return on asset, if you look at the definition, how we defined it earlier, it is your after-tax operating income as a percentage of your total assets. How many dollars of after-tax operating income are you making from each dollar of, how many cents of after-tax operating income you are making from each dollar of your asset? So in this case, for ABC, you saw that this operating profit margin was 6.6%. So it is making 6.6 cents of after-tax operating income from each dollar of the sales over here. So if you take it from each dollar of your asset, that will be your return on asset. So if I take this sales and take this ratio, operating of profit margin, times, if I do this, times sales divided by assets, which is your asset turnover, then sales will cancel out and you will get your operating profit margin, right? What do you get? Operating profit margin times, if you take your operating profit margin times asset turnover, which is sales divided by my asset, what will you get? Return on your assets, after tax operating income divided by your assets. So you can see over here that your return on asset, which is after tax operating income divided by assets, is actually your asset turnover, sales divided by asset, times your after-tax operating income divided by your sales, which is your operating profit margin we saw earlier. The asset, and the sales will cancel out, and you get after-tax operating income divided by your assets as a percentage of your asset. What does this mean? It means two things. One, that your return on asset is a function of your efficiency, your assets efficiency. And number two, it is the function of your operating profits, right? Two components of your return on asset. This is how you link these ratios together, and this is DuPont's system. So how can you improve your return on asset? You could, either by controlling your costs and getting your operating income high, or by, selling more, turning your asset faster. So both ways are good. Notice here, if you have less, like budget property, we all go to restaurants. So you have your McDonald's, or fast food restaurants, or Dunkin' Donuts, and those kinds of places. Whereas on the other hand, you have full service restaurants, upscale restaurants. Of course, they are not doing well just now. But if you have a McDonald's, you have to sell 1 billion burgers to make the profits, right? So the turnover has to be very high over there. Even though the margin is just for $1.99 burger or $2.99 burger, there's not much margin there. But your turnover can be high. So either way, you can improve your ROA. Got it? As opposed to upscale segments, when you're selling upscale properties, upscale, to upscale segments. If you're selling a room, a presidential suite in the President Hotel in Geneva, you just have to sell it once, and per night it will give you $80,000. That is the price. That's upscale. As opposed to motel number 6, hi, I'm Tom Bodetta, leave the light on for you for $39.99 or $59.99. You have to sell lots of those rooms to make your money. So again, 2 components of ROA is your turnover, which is your asset turnover efficiency ratio times your profitability ratio here. And you're connecting 2 ratios to see how your ROA is behaving. How can you calculate your ROA? So here, the after-tax operating income, which was, for this company, 4,946, and my assets for $40,742. So my ROA is 12.1%. Typically, ROA, around 10% is pretty standard. So 12.1%, very good return on asset. Alternatively, you can take the asset turnover of that company, 1.83, For ABC, we are doing the same thing. Same example we are continuing. So 1.83 times your asset is turning over times 0.066, which is 6.6% after tax operating profit margin. So if you multiply that, you'll get 1.121 or 12.1%. It's the same thing. So either way, you can get the return on ROA. If you have these 3 ratios, if you have 2 of these, you can get the third. Got it? And it shows you, gives you a deeper insight. Same thing with ROE, when you talk of ROE. So another example here. I'm not taking ABC, I'm taking XYZ. So firm XYZ has targeted 15% return on its assets. So from the 50% return on asset means what? Operating income. Operating income, after tax operating income, 15 cents, from every dollar of the asset. That is your ROA. Now its asset turnover is 1.5. So from every dollar of your asset, it is generating $1.50 in sales. So what should be its profit margin? Okay, very easy. You can get its profit margin by using this. ROA equals asset turnover times profit margin. 0.15 equals 1.5 times profit margin. So my profit margin is, I take 0.15 divided by 1.5, that is 10% is my profit margin. Profit margin is what? My net profit margin. That means net income divided by my sales is 10%. Got it? So we'll stop here. This is, you got a taste of DuPont system, and then we'll go more deeper into this. We'll stop here for some time. Okay, so now we talked about the investment part and the efficiency of the assets and the profitability of the assets. We'll talk about financing decisions. Are they adequate? Are they proper or not? Because financing decisions, they are, they can either boost your or complement your operating efficiencies, or they can work against it also. It depends. So that's why leverage, we call it leverage, leverage ratios. So with that in background, we will move into the financing decisions here, measuring the financial leverage. We'll talk about, remember here, when we talk about the shareholder value, whether you have improved value or not, market value added or not, it depends upon investment and financing. So financing decisions and whether I made prudent financial leverage decisions. So my debt ratios, interest coverage ratios, are they adequate or not? How much loans are we taking? Is that good enough or not? Sufficient liquidity? Do we have enough money to pay our day-to-day bills? We might show accounting income over here, but do we have enough cash? Quick assets, current assets, cash ratios, these are important over here. So this will be the focus here. As I said, the shareholder value also depends on good financing decisions. So the questions to ask over here is the available financing sufficient to invest, to buy you your assets? Is this financing strategy prudent, or is it dangerous? Is it too risky? Your leverage ratios are very important. They tell you how long your business, how long, long term, whether you can survive long term or not. If your leverage ratios are not right, then you will not be able to survive in the long run. So these are leverage ratios we'll talk about. We will also talk about, does the firm have sufficient liquidity or a cushion of cash or ability to convert its asset to cash? What is liquidity? A firm's ability to convert its assets to cash. So do you have enough liquidity, enough cash to work, to pay your day-to-day bills? So your liquidity ratios are very important. So when we talk of, we'll continue the book example here, the Home Depot example. The same numbers we will use here. So measuring the financial leverage using the Home Depot example we are doing. And when we talk of leverage ratios, they tell you how capable your firm is in meeting its long-term obligations, how much debt it has. Okay, so this can be expressed or measured in many ways. First of all, you can talk of total capitalization. Remember, when I said total capitalization means your long-term capital, your long-term debt plus your long-term plus your equity. Long-term debt plus equity is your total capitalization. So when we talk of long-term debt ratio, we can simply say how much is our long-term debt, the long-term. Remember, in accounting, there is a difference between short-term and long-term. Current debt versus long-term. Current liabilities versus long-term liability. And what is that difference? All the liabilities, all the debt that need to be paid within 12 months are classified as current debt or short-term debt within 12 months. And anything above and beyond 12 months is long-term debt. Okay? So that is the classic definition of accounting. So long-term debt ratio is how many cents of long-term debt I have borrowed for each dollar of long-term capital, each dollar cap, that is each dollar of long-term capital that I have raised. So what part of my long-term capital dollar is long-term debt? So that is your long-term debt ratio. The higher this ratio, the more risky you are, isn't it? The more long-term debt you have, the more you borrowed, the more risky you are. Okay. Now, there is something you have to understand about these ratios, and I will switch to the whiteboard again over here to explain it to you. And I'll take the eraser and erase this whole thing and come to what I need to talk about here. So you have, again, After the eraser is done, remove the eraser part. How can I write here now? Okay, new share, back to this, share, and new share, back to my whiteboard, share. Yeah. So now, when you have your operating income, so you have your, I will write operating income, op income. So you have your, okay, remove this. So you have your revenue minus operating cost will give me my operating income. Okay. Then minus operating income minus operating cost. Then minus my interest, which is my fixed cost, interest expense. That will give me my earnings before tax. Minus my tax will give me my net income. This is net income. This is the flow. Okay, operating costs and fixed costs are minus fixed interest and other fixed costs FC. Okay, so when we talk of leverage ratios, notice over here that this interest expense is related to debt. How much debt we have borrowed. It is related to your debt. Okay. So the more debt we have, the more interest we will have, right? This will become bigger, right? And my net income over here will be reduced because of my interest expense. Do you understand what is happening over here? My debt, I'm using my debt over here to reduce my net income, after tax income over here. So what is happening really? And when I borrow money, what happens? So this is my business. This is my assets. This is my debt. I borrowed, and this is my equity. The more this debt, the more this debt, the less will be the equity. Equity will be reduced. And if your equity is reduced, then what happens? The return on your equity will be boosted up because your equity will be less. It's the same asset, right? Debt and equity, asset equal debt plus equity. So the more debt you have, the less equity you'll have. And the less the denominator over here, the return on your equity will be more. You are using other people's money to raise your equity, OPM, to raise your equity. That's why people have debt. So debt has a positive effect on the return on equity. Debt borrowing tends to increase the return on your equity. Then why don't we keep on borrowing to the hilt? Because every dollar that we borrow more and more and more, our risk goes more and more and more too. The moment the economy dips, our revenues dip, the chances of our bankruptcy are higher if we are more highly leveraged. Because those costs are fixed, we got to pay those taxes, pay those debt service interests. So leverage is a double-edged sword. It has, that's why the Dutch call it the Hefboom effect. You borrow money, more money, and then the return on equity also increases. it also intuitively it makes sense because you take more chances. Risks are higher, return will be more. The equity holders will require more return too. So debt is a double-edged sword. Leverage is a double-edged sword. It can boost your equity return, and at the same time, it raises the risk. That is the negative side of it. So I just wanted to explain that, before I moved ahead with the rest, so that you understand. So new share, I'm back to my screen here. Yeah. So long-term debt, the more the long-term debt, the more risky we are. Yes. We are more risky. So this is called, again, every industry has its own average of how much they can borrow, how much debt, how much equity. And remember, when we talked of cost of capital, again, I'm going back to this, to the whiteboard. So when we are talking of cost of capital, the more debt we have, debt tends to lower the overall cost of capital also. You know how? Because of the tax benefit. Equity, higher debt, the cost of equity will become higher because it will be more risky, right? So the cost of equity will be higher. So when you take the weighted average cost of debt and weighted average cost of equity, weighted cost of debt, weighted cost of equity, add the two, that is the cost of your capital, right? Cost of capital. So cost of a little bit of debt, like some zest, some pinch of salt, or a little bit of zest in your pinch of flavor in your food, what it does is it tends to lower the overall cost of capital. So that's why they encourage that, have a little bit of that also. Just wanted to share that with you too. Go back to the slide. And we are back. So here the long-term debt ratio is 0.35. That means from every dollar of capital, long-term capital, every dollar of long-term capital that you have, 35 cents of that is raised through long-term debt. Okay. Then you have another way of looking at the same thing, your leverage, is your long-term debt to equity ratio. This is the ratio of your long-term debt to equity. Within the capital, within the total it tells you, how many dollars of equity, how many dollars of long-term debt you have borrowed per dollar of your equity. Again, industry makes a difference over here. The economy also makes a difference over here. Depending upon the economy, you can borrow more or you can borrow less. So here the long-term debt to equity ratio says is 0.53. That means for every dollar of equity in Home Depot that Home Depot has raised, $1 of equity, for every dollar that 53 cents, it matches 53 cents long-term debt it has. So 53 cents long-term debt to every dollar of equity. That is the Home Depot, example. Another way of looking at the same thing, leverage, is your total debt ratio, which is total liabilities to total assets. So the total debt, which is short-term plus long-term debt, is your total liability over here. Your total liability is the short-term plus long-term debt divided by your total asset. Simply tells you that 57 cents of your total asset has been financed by debt. Higher this ratio, the more highly leveraged you are, the more risky you are too. Again, this total debt ratio tells you It goes with the industry. With every industry, it varies. And you just need to know one. Once you know the total debt ratio, you will also know automatically what is your total debt to equity ratio. You will know that automatically. Why? Because of fundamental accounting equation. So here in this case, your debt to equity ratio is total debt over total equity, which is same thing, total debt divided by total equity, 1.31. But you don't need to know both. You know one, you know the other, using the fundamental accounting equation. Remember the fundamental accounting equation, total assets equal total liabilities plus owner's equity. Let me explain this again with an example. What will be the debt to equity ratio if a firm's total debt ratio is 0.75? In this case, it is 0.57. Let's say if it is 75% debt, 75%, 75 cents to every dollar. 75 cents debt and 20 debt to equity ratio. So for every dollar of equity, you have 75 cents raised as debt. So how much is the total asset over here? 75 cents is debt, $1 is equity, per dollar equity, obviously, debt to equity ratio. So your asset is what? $1.75, equity plus debt. So you can easily calculate over here. So in this case, my total debt to total asset is, my total debt ratio, which is total liabilities to total asset is 75 cents. Total liabilities to total assets. So my total asset is $1 and my liabilities is 75 cents. So my total debt over here equals 75 cents to every dollar of my asset, which implies that how much equity do I have? $1 asset, 75 cent debt. So my equity is 25 cents because assets equal liabilities plus equity. So my equity is 25 cents. So that way, if my equity is 25 cents and my debt is 75 cents, then my debt to equity ratio is what? 3 times. 75 cents debt divided by 25 cents equity, that's 3 times. So you just need to know one and you can calculate the other using the fundamental accounting equation. Okay. Again, these ratios vary with each industry. And of course, you have industry specific trend, range, and then within that range, or again, you have outliers everywhere, but firm specific decisions are also very important in that. Another way of looking at your leverage is how safe is your debt? And that is measured by the times interest earned. What is times interest earned? It simply is the ratio of your EBIT, which is earnings before interest and taxes. Once again, EBIT is earnings before interest and taxes. So how many dollars of earnings before interest and taxes you have to pay each dollar of my interest cost, interest expense? So for Home Depot, if I say $632 is my interest expense and my earnings before interest and taxes, this is an income statement figure, is $7,853 for the year, then my times interest earned is 12.4 times. 12.4 times. That means I have $12.40 of earnings before interest and taxes to pay each dollar of my interest expense. I'm quite comfortable. Banks, they look for anywhere, sometimes 2, 3 times, 4 times, 5 times is more than enough. 4 and above. But this is 12.4 times. So these guys are pretty safe. Their debt is pretty safe. And all these factors are taken into account when bond ratings are made. If you have a bond is what? Debt papers, right? So bond ratings, you need to know how safe they are. They will affect the bond ratings. So But again, this is again accrual figure. This is interest, EBIT. EBIT is again accrual accounting figure. It's not cash. So people who are more realistic, they want to know how much cash they have to pay the interest expenses, because the interest has to be paid by cash. You cannot pay by IOUs. So that brings us to cash coverage ratios, which is simply EBIT plus your depreciation. Remember the definition, cash flow, earnings before interest and taxes plus your depreciation, that will give you a cash flow. Depreciation is an artificial expense in the income statement. You don't spend cash for that. It's just a deduction in the value. So you add back depreciation and that will give you the cash. So EBIT plus depreciation divided by my interest payment, that is cash coverage ratio. So in this case, the cash coverage ratio is more because depreciation is there. So 15.1 to pay every dollar of interest, I have $15.10 of cash coverage, cash flow, which is very good. Whenever the cash coverage ratio will be greater than the times interest earned, that means there is depreciation in play. There is a positive depreciation. So keep that in account. EBIT plus depreciation is operating cash flow. So if the cash coverage ratio is more than the times interest earned, then the firm has depreciable assets. You should understand that. Make sense? Let's go more into DuPont and use this further. Apply it to ROE, operations, and leverage. So this is again using DuPont. Once again, DuPont can be used. It depends upon the analyst. You can have the DuPont tree as big and wide as possible. It's up to you. It depends upon you. So in this case, when we're talking of return on equity, we talked about return on assets, remember? Return on assets, we said, is a function of asset turnover times the operating profits, operating income, after tax operating income. That was the after tax operating profit margin. That was ROA, we said. If I take asset turnover B times C, this becomes ROA. We talked about that. Sales will cancel. After tax operating income divided by assets is my ROA. So B times C is ROA. We talked about this. We expand more. Now let's connect it to ROE, return on equity. What is return on equity? Return on equity is net income as a percentage of your equity, right? Net income as a percentage of your equity is return on equity. Net income divided by equity. You can expand this ROA by multiplying debt, asset over equity, another kind of leverage ratio, asset divided by equity. How many dollars of assets you have for every dollar of equity that you have invested? Remember, assets minus equity, you get your debt. So assets over equity is a kind of leverage ratio times this ROA, sales divided by assets times after tax operating income divided by sales. This is ROA. B times C, B times C, B times C is ROA. This whole thing is ROA, return on asset. And this is asset turnover. Sales divided by assets is your asset turnover. And operating income, after tax operating income to sales is your after tax operating profit margin. So if you multiply that with your net income divided by after tax operating income, you will get the ROE. See, sales and sales will cancel out over here. Assets and assets will cancel out. After tax operating income and after tax operating income will cancel out. Assets and assets cancel out. sales and sales cancel out. After-tax operating income cancel out. What is left is net income divided by equity, which is return on equity. So what is the advantage of this? This is a very, very important DuPont application because it tells you that your ROE, as I said, ROE components A and D, these two, the outer part, this and this, D and A, they depend upon your debt equity mix or your capital structure. Capital structure is the mix of your debt and equity to raise your capital, which is a very important, it's a subject by itself in finance, in corporate finance, So capital structure will affect your leverage ratio, the proportion of asset to every dollar of equity, and your debt burden, which is your net income per dollar of after-tax operating income. Remember, net income is a function, it depends upon both operating and financing. And after-tax operating income is what? Your net income plus 1 minus tax rate times your debt interest. So net income divided by after-tax operating income is your debt burden. And it simply shows over here that your ROE components B and C, which is your ROA, and which depends upon the firm's production and marketing skills, not on the capital structure or financing skills. B and C, sales and assets, after-tax operating income, sales, this depends upon the firm's production and marketing skills and not on its debt equity mix. But, A and D, the outer two components, depend upon the debt equity mix or the capital structure. You understand? So, putting 2 and 2 together, what do you understand? We simply understand that a firm's leverage tends to increase its return on equity if its return on asset is greater than the interest rate paid on the debt. Leverage, as I said, it's a double-edged sword. So the first advantage part of it is your ROE will be boosted. Remember I said ROE will be boosted? Only as long as your return on asset is greater than the interest rate paid on the debt. If the interest rate is more, see, if you have no debt, then equity over equity, this will be 1. The assets, your asset will be equal to your equity because there is no debt. That will be 1. The operating income over here, there will be after-tax operating income, there will be no debt over here. So net income divided by net income will be 1. So your ROE will be equal to your ROA. Same thing that we talked earlier. When there is no debt, then ROE equals to ROA. But if you have debt, then this leverage will work to your advantage and it will boost the ROE as long as your ROA beats the interest rate. It is greater than the interest rate paid on the debt. If the ROA is less than the interest rate paid on the debt, it will start digging your grave more. So that's why it is a double-edged sword, So be careful of this. You can use it to boost your, normally in in booming bull markets, it helps, it is good. But in bearish markets, there is a big problem. So keep that in mind. Also, another way of looking at it, so do you understand what I'm trying to say? This is a very, very important concept to understand. ROE is a function of ROA and your asset over equity times your debt burden. Okay. Keep that in mind. Another way of looking at it is ROE as a function of, which is net income over equity, as a function of your leverage ratio, asset over equity, times your sales over asset, which is your asset turnover, times the net income to sales, which is your profit margin. Just three components. So you just, as long as you have two, you can find the third. So in this case, let us say ABC has a total asset turnover of 85 cents to a dollar. So 0.85, cents of sales per dollar of asset. And operating profit margin of 0.15, 15 cents to a dollar of revenue. And my debt to equity ratio is 25 cents, debt to every dollar of equity. Then what should be the return on equity? You can easily find out by connecting the leverage ratio, which is by connecting the total asset turnover and the profit margin and the leverage debt to equity ratio over here. Because from debt to equity ratio of 0.25, you can find the asset to equity ratio very easily. Your debt to equity ratio is 0.25. Simply means that your debt is 25 cents and your equity is $1. So your asset is what? $1.25. Fundamental accounting equation, asset equals debt plus equity. So if you know that your asset is $1.25, then you know your asset to equity ratio, because your asset is $1.25 and your equity is $1. So your asset to equity ratio is 1.25. So you have your asset to equity ratio, you have your asset turnover. Your asset turnover is 0.85 and your profit margin is 0.15. Multiply all the three and there you get the ROE. So your ROE is net income over equity equals asset over equity times sales by assets times net income by sales. 1.25 times 0.85 times 0.15, it's 15.94% is your return on equity. The nice relationship over here. So, it shows that your return on equity, it is affected by your leverage, your debt, your capital structure, your debt to equity mix, and of course your operations both. So keep that in mind. Very important. So finally, after we talked about leverage, financing decision also talks about measuring liquidity, measuring growth. We'll talk about window dressing, also another limitations of financial ratios. So I'll just go through these. Liquidity, as I said, measures your ability to convert your liquidity means your firm's ability to convert assets to cash. So liquidity ratios measure your company's short-term strengths. So we are under this part now. Sufficient liquidity, this part. So liquidity ratios, I said liquidity measures how easily your assets can be converted to cash. And liquidity ratios help measure your firm's ability to meet its short-term obligations. Creditors look for them. If they will lend you money, they want to know that you have enough money to pay your debt service. So focus is more on current assets and current liabilities. Remember, current assets, those assets that have been converted to cash, immediately within 12 months. And current liabilities, those liabilities that have to be paid off within 12 months. Together, current assets and current liabilities constitute your working capital, day-to-day working. And your net working capital, so the current assets include your cash, marketable securities, inventories, and accounts receivable. These are all from your accounting. These are quick assets, not exactly quick. Quick assets don't have your inventories, but cash, marketable securities, accounts receivable, inventories, these are current assets. And my net working capital is the difference between current assets and current liabilities. Net working capital is the difference between current assets and current liabilities. Shows how much cushion I have over to pay my day-to-day bills. So my net working capital to total asset ratio simply tells me current assets minus my current liabilities, which is my net working capital, divided by my total assets. That is, in this case, it is 0.10. So I have 10 cents of net working capital for every dollar of total assets that I have. The higher this ratio, the safer I am, the more liquid I am. So it's very important to have a good net working capital. My net working capital, current assets minus my current liabilities. Then other ways of looking at it is your current ratio and quick ratio. Current ratio is very general. It simply tells you how many dollars of current assets you have to pay each dollar of current liabilities. Technically, you should have more than $1 of current assets to pay. You should have at least $1 of current assets to pay $1 of current liability. Match it, In this case, I have $1.34 of current assets to pay $1 of current liability, so I'm good. But it doesn't mean that, yes, overall liquidity is good. It doesn't mean I have enough cash to pay my bills, because all the current asset could be sitting as inventory, for example. Then what are you going to do? Your current ratio will still show very high, but you won't have money, cash to pay your day-to-day bills. So you want to look at other dimensions of liquidity. So quick ratio or acid test ratio. Quick ratio is also called the acid test ratio, where you take the quick assets. Notice, my quick assets are all my current assets except my inventory, cash plus marketable securities plus receivables. But there is no inventory over here. Inventory is not considered quick because, it takes time to convert them to cash. So that for every dollar of current liabilities, if I add these three, I have only 34 cents of quick assets to pay each dollar of current liabilities. So it is less. Okay, not $1 of quick assets. But I want to know cash. Do I have enough cash to pay my current liabilities? So your quick assets are cash plus marketable securities plus receivables. Okay. So you can go deeper and you can find what is your cash. How much cash do you have? What if your current ratio is very healthy but quick ratio is unhealthy? What will it mean? If your current ratio is very healthy, very good, quick ratio is very bad, that means bulk of your current assets are blocked as inventory over here. You do have a lot of inventory over here in Home Depot. Do you understand? So, but you want to know your cash, how much cash you have to pay your day-to-day bills. So your cash ratio is very important. Cash plus your marketable securities. You can just with a phone call or a quick punch of computer button, you can convert your investments to cash. So your cash ratio to current liabilities, in this case, it is 22 cents of cash you have to pay each dollar of current liabilities. Now again, is it good? Is it bad? It depends upon the industry that you're working. If you are going to mining industry and petroleum industry, mining industry, they believe in hanging on to a lot of current ratio and a lot of cash. What if they go into a venture and then it is a dead end? Then everything is gone, washed, right? They have to come back fresh. So they have to have a lot of, cash to back them up. So again, it depends upon the industry. So cash plus marketable securities over current liabilities, cash ratio is very important to know this. And finally, you need to know how to measure your growth also. So your payout ratio is very important over here. How much are you paying to your shareholders, right? Are they going through dividends? So how many cents for every dollar from every dollar of earning are you paying out as dividends? And what happens to the balance? Here you are paying out 38 cents from every dollar of your earnings as dividends to the shareholders. And the rest, 62 cents, what is happening to that? Is being plowed back into the business for growth. So you can measure growth either through your payout ratio or directly also through your retained earnings. Remember, every dollar of earnings, you can retain it, part of it as retained earnings to the business, and part of it goes out to the shareholders as dividends. Some companies are high growth companies, they retain back a lot. They don't pay a dime of dividends. Otherwise, your utility company, and they'll give a lot of dividends. Real estate investment trust, REITs, they'll give a lot of dividends. So again, you can measure growth either way through the payout ratio. Now, when you look at these ratios, another important thing is window dressing. Okay, window dressing means when you go for loans and all, you make your ratios look good. Every company does that legally; it is allowed, as long as it's not illegal. So strategies used by companies to improve appeal of the company's financial statements and ratios to external users, so banks, creditors. So if you sell off your fixed assets with large amounts to accumulate depreciation associated with them. You can also use its proceeds to pay off current liabilities, improve the current ratio. Lots of things happen. You can do those kinds of strategies to window dress. So we do that all the time, So long-term loan to pay off short-term loan, right? Reduce the interest rate. They do garage sale, yard sale. They're selling off their unused assets, to improve the liquidity this side. What is all this? Just window dressing examples. But can you use your current assets to pay your current liabilities and window dress, like your current ratio, liquidity? Could we improve the current ratio if we sell off excess marketable securities, which is current asset, to pay off current liabilities? Very important question. You have current assets and current liabilities. Taking off a part of current asset to pay off a part of current liabilities, will that improve your current ratio? Because current ratio is what? Current asset divided by current liabilities. We take a part of the numerator to pay off the part of denominator. Will that improve the current ratio? The answer is it depends. You can use that for window dressing too. You can sell off your marketable securities to pay off your current liabilities. To window dress your current ratio, improve your current ratio. This will only work. When does it not work? Number one, if your current asset and current liabilities are equal. So if you have current ratio 1, it is not going to work, because you take 50 cents of current assets to pay off 50 cents of current liabilities, remain 50-50. Will remain 1, not change. But even if your current ratio is 1 cent above 1, 0.000 something is greater than 1, it will always work to your favor. Simple arithmetic. As long as this ratio, current asset to current liability is greater than 1, window dressing by using current assets to pay current liabilities will always work to your favor. It will improve your current ratio. But if it is less than 1, it will start digging your grave. It will work against you. You can check it out. It's simple arithmetic. So you have to window dress strategically if you are using your current ratios. You're selling off your marketable securities to pay off your current liabilities. Yes, as long as you are in the positive, it will work for you. If it is your negative, it will reduce your current ratio further. So be careful when you use this strategy. Okay. Finally, limitations of ratio analysis. Limitations of ratio analysis. Remember, they just tell you the ratio analysis, just tell you symptoms. Okay. It just identifies the problem area, but does not tell you the solutions. Financial ratios do not provide final answers, although they should improve your insight, should prompt you to the right questions, how to go about it. but does not tell you the solution. Also, accounting entries and book values do not always reflect current market values because simple cost principle, the book values don't have the market values in them. That's the cost principle. So keep that in mind. Doesn't give you the actual picture. Qualitative factors affecting firm performance are not included. So employee morale, strike, those kinds of things, they're not included. For that, you have to use balanced scorecards, Six Sigma, those kinds of things. Balanced scorecards, very good too. Then time and inflationary effects are not considered over here. This is what we are going to do after this. How to make our decisions more realistic, investment decisions more realistic by including time effects into it. Present value, future value, those kinds of things. How to make right investment decisions. Incorporating inflation into our decisions and the time value of money into our decisions. This is what we'll do next after this. So we'll, stop at this point and continue more when we meet next time. We'll stop recording.